Hello everyone. Do you believe in sell in May and go away? In general, most people believe that May is a period to go for vacation. Hence, there will be lack of market participants, which then leads to lower market volume and cause the volatility. Another common belief is April as one of the most bullish months because most companies will release their good earnings and trader or investor will profit that and cause a decline of the market in May. Thus, how to adjust our investment strategy? Here, I'm going to share my buying point strategy with a simple 3 steps on how to deal with a volatile market. Hello everyone, I'm Jay from JM Investment Journal. For those who are the first timer here, this channel is to record my investment journal on long-term investing and cash secured put strategy to retire myself early, so I could enjoy my time with my family. Please subscribe our channel, turn on the notification bell if you would like to know my strategy to retire myself early in stock market. Let us start with the past market performance in May for the last 10 years. Here are the 3 indexes on their opening and closing price in May for the last 10 years. All 3 indexes have a 70% of price increment in May for the last 10 years and 80% of the price increment for the last 5 years. Based on the statistic, please make your own judgment that should we trust in sell in May and go away and sell our stocks now? Of course, past performance does not necessarily reflect to the coming performance. By the way, if the stocks are sold off because of sell in May, does this affect the fundamental of the stocks? No, right? Means it will be a good time for us to look for a bargain. However, while we should not be too worried about sell in May and go away, it is still important for us to know the current macroeconomics that would affect the market movement. In this video, I'm going to share my point of view on the current market analysis and a brief macroeconomic update that could affect the stock market. Next, I will share from my macroeconomics point of view how to use my buying point strategy that can be used in any time for all the markets. In addition, as many companies have announced their earnings, I will also update the valuation for my Moomoo account and also some of the stocks in my watch list. Overall, in the current earnings seasons, from the 88% of the companies in the S&P 500 have reported actual results for Q1 2021. 86% of them have reported EPS above estimates, which gives me a confidence that the current market is still healthy and I'm still bullish on it. Next question is, which stock to focus on? Let us start with a very simple macroeconomic analysis. Now, the current focus is the economic recovery from the impact of the COVID-19 pandemic. When the economy is recovering, inflation and employment rate are one of the most important parameters to look at. In general, economic recovery and increasing of inflation rate is inevitable. Look on the data from the trading economics, unemployment rate is steadily decreasing since the last year after the COVID-19 pandemic started. Similarly, looking on the CPI index and inflation rate chart, they are increasing as well. In general, when inflation is increasing, rate hike is one of the methods to control the inflation. Thus, we could also forecast Fed will slowly tightening the money easing policy or the QE policy. It may not be now, but it will sure happen in the future. In addition, to support the economic recovery, the US government will also raise the tax for the companies to raise money. In summary, the current macroeconomic trends are economy is recovering, higher inflation, rate hike, higher tax. From here, let us check which are the sectors that could be hit hard or benefited from the current macroeconomic trend. This could help us on deciding which sectors or stock to focus on. Let us see which sector will be hit hard. Higher inflation and rate hike will definitely hit the stocks in growth stocks, especially the companies that are still not profitable yet. Many of the growth stocks are within the technology sector. Therefore, Nasdaq index or the technology sector are the most susceptible to the inflation and rate hike. Why? Let us look on the discounted cash flow formula or DCF. Let me try to make this simple to understand. We can assume that a profitable company will generate cash flow, and DCF is to measure how much money it will generate in the future. Many growth stocks such as Neo, Palantir, Teladoc Health, Unity Software, Nano Dimension are not profitable yet. They are not able to generate cash flow to the investors yet, but investors are expecting or speculating these companies will be profitable and generate a lot of money in the future. Thus, the speculation and hope are the main reason to drive their stock up. I hope you learned something new here, as we really spend a lot of time to deliver the best to you. Plus, we are going to prepare more videos to help you to kickstart your investing journey. I hope you could click the like button to motivate us more. If you have not subscribed to our channel, please click on the subscribe button and turn on the notification bell to get our latest updates. If you think that this video could help others, please feel free to share it too. Please join our Telegram group in the description if you would like to engage with a group of like-minded investors too. Let us look back on the DCF formula. Now, if the interest rate is increasing, R is higher, and it will bring the DCF lower. In addition, for a longer period, N will be increasing too. This will further bring the DCF values lower. Consequently, growth stocks that are still not profitable is expected to generate a lot lesser money in the future. When a company is expected to produce lesser profit, do you think that the stock price will be higher or lower? It will be lower because at higher interest rate environment, it won't be able to support their high valuation. Moreover, based on the history, the rate hike was happening across a few years. When R is increasing, DCF will be much lower in the future because of R and the N. This is the reason why growth stocks, especially those speculative stocks, are being hit hard during this period. For example, ARKK, which is holding a lot of non-profitable growth stocks, are being hit hard for almost 30%. Does growth stock still have hope? Yes, absolutely. Refer to the DCF formula. These companies need to prove that they can beat the investors' expectation by producing a good earning. Back to the formula, when they could produce good earning, CF value will be increasing. Increase the DCF value. In addition, this will lower their price to sales ratio or price to earning ratio to justify their valuation. Roku is a good example here. Its earnings report is so excellent and spiked its stock out 11.6%. If the growth stock release a normal or a poorer earnings report like T-Dot, the stock will further tank as its CF value could not support its DCF. T-Dot suffered a drop of 11% after release its earnings. Summary for the growth stock. We do not know how long the rate hike will be happening or how high the interest rate will be. The uncertainty for growth stock is huge for the coming years. Thus, I would not focus on the non-profitable growth stock at this moment. How about the other technology stocks? As long as the technology companies are still profitable and below their intrinsic value, they are still my favorite. Whenever there is a dip on the technology stocks, I will add them. For example, Microsoft and Google are my current favorite. Their current price are below their intrinsic values. Based on the DCF, they manage to generate more and more profit. Thus, CF also increases. Using DCF of 10, we can then calculate their intrinsic value. I will be sharing their intrinsic value in the latter part of the video. Moreover, Google, Facebook, Apple, and Microsoft can also benefit from the economic recovery, such as small companies will look for advertisement services through search engine, Google, social media, Facebook, and LinkedIn. Microsoft. For Apple, the stronger buying power would also benefit their product sales. Although the short-term gyration of the technology stock could hit them, but eventually, in my opinion, they will still continue to grow and profitable. In addition, profitable stocks are considered as asset, and asset will rise in price when inflation is higher. Lastly, higher inflation rate and economic recovery will benefit bank and commodities as the demands are higher. Thus, material sector XLB, energy sector XLE, and finance XLF have a very nice bull run this year. However, I am not keen to add the stock in these sectors at this moment because the risk-reward ratio does not look attractive to me. I will wait for the dip. For instance, I have added XLE 2 weeks ago when it dips to around $46. I will keep my target price at $64. Sector rotation is still occurring. Money is still flowing from the technology stock, especially from the speculative stocks into the value stocks. By the way, we should also note that the current market seems has priced in the recovery and good earning. Any potential black swan that would hinder the economy recovery could hit the market hard, especially those value stocks that have priced in the future recovery. For example, the COVID-19 situation in India is out of control now, or the mutation of the virus will cause the vaccines ineffective. These are also the reasons that I do not want to chase the high of the value stocks. However, let us pray together so this pandemic will be over soon, as there are too many people are suffered. In summary, during this period, if any dips happens, I will only focus on the big cap profitable stocks, Microsoft, Google, or ETF, VGT, VIG, QQQ, SPY. I will avoid non-profitable growth stocks or keep their portion low in my portfolio. After get an idea on the macroeconomics, next, let us look on my strategy to identify which stock to focus on and how I identify the buying opportunities.